were insolvent, i.e. Robinhood. Jason, over to you.
Okay. I think we probably agree on a lot of things here. Thank you for the concise overview. We agree that Wall Street bets and retail investors are incredibly powerful now, and we agree that that's a good thing. We also probably agree that there are shenanigans going on with shorting of stocks, i.e. 120% or 130% short. And we agree, I think, that some of these hedge funds do manipulate the markets with these. We all also agree that it's unfortunate that in order to stay solvent, Robinhood, apparently, if this is the information, we don't have complete information right now. So the thing I do think that you're being tremendously unfair about, and I'll try not to make it personal, Chamath, is that you've been uncouth and you're attacking people with partial information. I'll let you respond to that in a minute. And I think we agree that Robinhood is responsible. Robinhood is responsible for this revolution in retail trading. They created the platform and they created the innovation that got millennials to en masse embrace trading stocks. How did they do it? They figured out a clever innovation of how to make it free and friction-free. They did that because they did this selling of the data and the order flow. Okay, we can debate whether that is fair or not, but Facebook did the same thing. They created a data business. They provided amazing products and services that you yourself built for 5 years and made $1 billion off of in order to make it free for consumers. Now, there are unintended consequences of any company at scale, whether it's Uber, Robinhood, Tesla, etc. And they will all have to weather these storms. And I think that there are pieces of information that you do not have, Chamath. And for you to say that they're criminal and for you to say they're scumbags and to act this way is, I think, unprofessional and does you a disservice and does your argument a disservice. And you did this as well with Uber, another one of my investments. And that company weathered the storm and they've done great things in the world. And I'm very proud of that investment.
No.
And I will be very proud of what I believe that
Uber fired
Robinhood
their
will do.
CEO and they brought in Dara who cleaned it up.
Oh, agreed. But they got there. And so,
well,
let's
see what happens. So what do you know that I don't know?
Well, I haven't talked to Vlad. I saw what he said.
Who cares about Vlad? He lied on television.
I don't believe he lied.
He lied on CNN. He lied on Fox. Where did he not lie yesterday?
What is the lie?
Well, Jason,
he was confronted about whether there was a liquidity crisis, and he said to their face, "No, that is not true."
I think this is being misinterpreted, and there'll be a clarification that'll occur. I think because they were able to draw down $600 million and because they were able to take down $1 billion investment from the top investors in the world, that they resolved their liquidity problem. Nobody in history has ever created this many retail investors than Robinhood. They are responsible for the movement. When they pitched me the company, they wanted to create this revolution. It is paradoxical that they are now the enemies of the revolution because they actually created and enabled this. And they have been number one in the App Store since this whole fiasco started.
Nothing you're saying convinces me. They are the Lehman Brothers or Bear Stearns of 2008 to me.
And they will not be. They will get through this. And this is an unprecedented black swan event. I think we would all agree. Nobody has
exactly what Lehman and Bear said. That is exactly what they said.
And they will, I believe, Robinhood will ride it out because they throttled the number of people coming to the platform. Las Vegas is not designed for everybody in America to come to Las Vegas in the same weekend. That's what's happened.
Will you admit that the tens of millions of people that had their hard-earned money inside of Robinhood was prevented from participating in trades that could have been executed other places because of an arbitrary decision by Robinhood that they had at a minimum?
It wasn't arbitrary. They had to stay insolvent. How is that
Jason,
an arbitrary decision? Do you think they wanted to make that decision?
Jason, that's me telling you that they were insolvent. That's not them saying it. This is what I'm saying. Right now,
the communication was not perfect. I'll agree. The communication was not perfect. They should have just said, we had no choice but to stop this or we would have been insolvent. We cannot take this many trades.
Is that what we call lies when people's money gets fucked over? Just, it's inconvenient.
Let me just say one thing. I'm going to interject your vigorous debate. The important thing I think to note is Robinhood makes money effectively, as Chamath pointed out, through arbitrage of pricing in the markets and by providing leverage to their clients. So the clients can trade beyond their means. I used to be an investor in a Forex trading company. It was the largest Forex trading platform in the world for retail investors. And 60% of those accounts went bankrupt over time. So there was a lifetime value on an account because the customer would come in, they'd trade foreign exchange rates up and down. They would ultimately just get burnt up, and that was it. Robinhood makes money when the market is non-volatile, when there isn't a lot of swings. Suddenly, when there is a swing, and that's how they're able to provide their free pricing to people, they're making a spread. But suddenly, when there is a swing and the spreads start to widen, they are actually exposed to losing money. So, Jason, it's true what Chamath is saying. Like, they did face a liquidity crisis to some extent. That's why they had to draw down additional equity capital.
Yeah.
But it was a function of their business model, right? Their business model provides great benefit and value in some extent during good times, but when times get bad, it's like, oh shit, things are at risk. And that's very similar to kind of the Lehman and
I don't disagree.
model.
I don't disagree. I think this is an unprecedented situation with the number of participants. It reminds me of surge pricing with Uber during snowstorms. And that also was an unintended thing that, who knew that it would go up to $400 to take a ride? And that's something that companies will be faced with, and they will have to then adjust and then make it work. And I think, in the case of Robinhood, they should have just came up on Wednesday and said, we can't take any more orders. We can't take any more new customers. We're pausing signups. You'll be on a wait list because we will be insolvent if you guys make any more trades. And that would have, I don't know if you believe that would have.
I agree with that.
Okay.
So Jason, let me just explain the mechanic.
So then it's poor communication from a rookie
It's
founder.
not. Jason, it's beyond poor communication. People were blocked out of their accounts. Like there was hundreds of incalculable amounts of economic loss.
I don't know if that's going to wind up being true because all these trades are occurring now and the stock is a rocket ship. Who's to say that?
No. Jason.
And aren't the shorts all covered by now? That's what they've been saying on CNBC.
No.
There are still people. How do you know how many people are short right now and how many shares?
Because it's the primes put the data together and they send it to us.
Do you have it handy? Because I've been looking for it online and they said 10 times the number of shares short have traded hands in the last 10 days or 5 days.
Jason, I don't have it literally in front of me, but I could get it in the next hour.
Well, yeah, just text one of your people. You got all these researchers there. Go ahead, Sacks.
Okay, look, I'm going to try and thread the needle here. I think JCal is right that we shouldn't impugn people's motives without having all the information. And furthermore, building these rapidly scaling startups is really tough, and it could have just been, a function of not knowing how to deal with unprecedented growing pains. So I don't want to be too judgmental.
Can I just stop you there?
Yeah.
No, but that's not. No, but David, that's not. But you guys are not being accurate. They have known for years, how this business worked. When somebody buys a call option, they are legally obligated. When they send that order through, they have to post margin on behalf of that person. So they saw this building. This happened in March of 2020. They went through this liquidity crisis. They've had to draw credit lines before. They saw it building in the system. So this was nothing except negligence.
Yeah. So I was about to, I hadn't gotten to the point where I was about to agree with you, Chamath. I mean, look, all I'm saying is even if it was negligence, I'm not sure I would impugn all the motives to them. That's all I'm saying. I'm trying to find some common ground with JCal on that point. But where I totally agree with you, Chamath, is with respect to the effects of their decision. I mean, the effects of that decision they made to stop trading, and specifically, they didn't stop people from selling. They only stopped people from buying. So they shut down one side of the trade. And the effect of that was we had these hedge funds from Wall Street. They were on the ropes, right? I mean, let's discuss who these guys are. These are the apex predators of Wall Street. They are in the business of shorting companies to destroy them. I mean, that is their business model. And they are not academic traders, okay, who are just speculating on outcome. They engineer the outcome, right? Look at their tactics. Just watch the show Billions, right? They hire PR people. They hire private investigators. They're participating on these message boards, spreading disinformation. Look at the year of hell that Elon went through, right? They tried to destroy
It's like 5
Tesla.
years. Yeah.
Yeah, exactly. They try to destroy companies to engineer that outcome. They create nothing. They are in the business of destruction. Now, the beautiful thing is you had these Reddit kids, these pirates, who published this manifesto, right, on Reddit, basically being the heirs to Occupy Wall Street. They recognize, look, occupying like a physical space does nothing to these guys. We are going to hurt them where it counts in their pocketbook. We are going to get together and we're going to basically create a trade mob that's even bigger than their cartel. And they did. They got 2.7 million people taking the other side of this trade. And then when the hedge funds doubled down, they said, fuck you. We're going to triple down. And the guy on Reddit said, listen, he, paraphrasing John Maynard Keynes, said, we can be retarded longer than you can be solvent. And they were winning. That was what they said, right? And they were winning the trade, okay? And Melvin was dead busted and Citron was on its way to being dead busted. And they had to go to Big Papa Stevie Cohn, okay? And Ken Griffin to get their rebuys, to buy their rebuys to get back into the game, okay? And then they had these guys on the ropes. They had them felted, okay? And then what happens? Just at the moment where they're going to like basically bust them out of the game for good, Robinhood shuts down the buy side of the trade. And so what does that do? It gives these hedge funds time to regroup, to unspool the trade, to reposition, and save themselves, and to get out of the trade if they want to get out of the trade. You can never take that 24-hour time period back, no matter what Robinhood does now. And so I agree with Chamath. This was
don't you think, David, on that point, I think I am in agreement that the hedge funds deserve to get their asses kicked 100%. I also, as I said, we don't have complete information of why, Robinhood had to pause trading and the other platforms. And it was like 5 platforms, by the way, that had to stop or else they would be insolvent, because nothing like this has ever happened before. This is a run that nobody's ever seen. And now we're back in the game. And don't you think all this attention then drives more people to buy GameStop, which is what's happening today? And that they're still going to get crushed because they're still going to have to cover. I mean,
I don't like I said, look, where I agree with you is I think the consequences of this decision by Robinhood they were really bad, right? I mean, we finally had these shorts on the ropes where they deserve to be. Finally, they're getting a taste of their own medicine.
Yes.
And it was really bad to pull the plug on the
and they wish they didn't have to, I'm sure.
Okay, exactly. And I don't know what went into that decision, but here's the thing that I think kind of stinks about it is the point that Chamath is making about who is doing the trade execution for Robinhood. Those trades are flowing to Citadel.
Well, that's part of it.
That's part of it, but 47%. But who is now on the short side of the trade? Citadel went in and bailed out Melvin and Citron. And so they're on both sides of this trade. Now, how does that make sense?
Well, Citadel, but I mean,
what I would like to know specifically, okay, is did anybody from Citadel reach out and touch Robinhood? Did anybody at Citadel put in the fix and saying to Robinhood,
of course, that's a valid question. Valid question.
We're gonna cut you off, unless you freeze out the buy side. Now, look, 99% chance that didn't happen. I don't know, but that is a legitimate question. We need to know the answer to that.
Can I just tell you the question is important, but the way that you phrase it is you call them and you basically say, listen, you need to post $500 million of margin. Why? Oh, well, these trades, we're going to arbitrarily change the margin requirements. Okay. Oh, hey, you need to post. So then what they did was they pulled all the credit lines. Okay. They post margin. Trades are still happening like crazy, right? All these people are buying GameStop calls. They have to go because look, when you buy a call, when you as a user, when David Friedberg, Quinoa buys a call, Robinhood becomes synthetically shorted, right? Robinhood doesn't have the share to sell you, but it's giving it to you. So they're technically short. They got to go buy it. Okay. So this is what creates this dynamic where Robinhood knew. They knew every second of every moment what was happening and more importantly, what could happen. At a minimum, it's negligence, and at a maximum, it's the fix.
Well, it was fine to do it before the market started to swing volatile, right? And so when the market wasn't high volume and when it wasn't volatile, it didn't matter because they had appropriate levels of surplus capital or statutory capital or whatever the definition is in this market to be able to cover the quote unquote VAR or the value at risk of their portfolio of their customers' worst case outcome. But as soon as that spiked, as soon as the VAR spiked, they had to go get more capital. And so what do you do if you're the manager of Robinhood in that situation where your clients who've been making you a bunch of money by trading stocks over the last couple of years, suddenly they all get themselves in a bind where the VAR on the portfolio is more than the cash Robinhood has to clear, assuming all these people go bankrupt, that's where Robinhood had to scramble. And so in that circumstance, they drew down debt and they had to go get $1 billion of equity. But if you guys were running that business, and I'm not speaking for Robinhood's, I'm not making the case for Robinhood, but what would you guys have done in that circumstance? You know, suddenly all your, and by the way, I'm saying they created the problem for themselves because they allowed people to trade on margin with low account balances and volatile stocks. Prior to this, it got away from them in this week.
You cannot run a business like that and be selective and arbitrary. You can't say some stocks on certain days, some stocks on other days, some options over here, some puts over there. That means you're a fucking moron. And
but what
you
do you do on Tuesday or Wednesday when all of a sudden your exposure...
It's not Tuesday or Wednesday. If you were a reasonable manager of a business like this conversation would have been happening at a board meeting quarters ago. Hold on a second. Let me finish, please. Okay. It needs to happen quarters ago. And in quarters ago, what they would have said is, hey guys, we've run some scenario analyses. We've done some sensitivity analyses. Here's what happens if all of these things can go against us. That's a typical stress test that a bank has to do, right? When you're a structurally important bank, you have legislation that forces you to be under these conditions where you have to make sure that you can understand some of these scenarios. And then you have to have...
Same with any trading entity or insurance company, they all have to have that analysis of what's the worst case scenario and how do you plan for it.
And you have to... And by the way, coming out of 2008, we actually legislated that we needed to have these 2 and 3 sigma, event scenario planning, and you needed to have proper credit. So here's what happened really. Number one, it was under-equitized. Right. At a minimum, the business was massively under-equitized.
Relative to what they were letting their customers do.
Exactly.
Right? And that's really important because the point is they let people trade with high margin and they let people trade in volatile stocks. And it was working until the volatility...
Not just stocks, but options. Which is what creates the real spin up.
The feedback loop that blows this whole thing up.
And then number two is they don't know what they're doing.
I think one thing that's really important, I just want to say this. We should stop pretending that trading in stocks is investing in businesses. And this is something we've said for a long time on Wall Street, but stocks, shorting, margin, and derivatives, those 4 things no longer look like what the capital markets were originally set up for, which was to help capitalize businesses and allow people to exit their investment in helping to capitalize that business to another investor that wants to come along. It has effectively become a synthetic casino or a synthetic gambling model that lets people trade things up and down. And this has been the mainstay of Wall Street for the last couple of decades. And as you pointed out, Sacks, it really is a leech on the system because the amount of money that trading firms and traders and hedge funds make doing this ultimately is taking away from capital that could be invested in actual businesses that could drive job growth, drive economic prosperity, drive innovation. And the volatility that I think we've seen is the ultimate feedback loop that emerges from when you allow a casino to operate that sits under the guise of being business capital and investing in businesses. It's not. I'll give you guys a statistic. I downloaded the data from CBOE that analyzes how much volume was traded across all the equity markets last year in the US. Stocks traded a total volume last year. You guys ready for this? $121 trillion of notional across 2.7 trillion trades. Do you think that $121 trillion of notional equity value trading provided capital to businesses anywhere close to 1% of that total amount of trading volume? It really is a synthetic instrument that allows people to participate in, I bet that something is going to go up and I bet that something is going to go down with other people of a similar ilk. And one person makes money and one person loses money. And at the end of the day, the underlying business entity doesn't benefit whatsoever. And you see it when shorts go against businesses like happened with Elon and Tesla. And you see it when derivatives like CDOs blow up the fucking housing market, where people basically trade these derivatives that sit on top of housing, and that capital did not find its way into homes to help people buy homes. It ultimately led to the collapse of the
only reason that Lehman and Bear Stearns was shut down was in 2007 and 8 when they were in a liquidity crunch and the same thing, and they basically had all these trades blowing up against them, and they couldn't collateralize them. Was that the people on the other side were hedge funds. And that's why, they were put into the Fed. And that's why we were able to basically come out relatively unscathed. And what I mean by relatively unscathed is like a global calamity. The tragedy of this is that this is the tragedy of the commons. It's like, there is no organization of people that can say, hey, listen, I'm really rich and wealthy, and what happened here was wrong, even though it's probably on the same scale. And so everybody that was a participant in it is, in my opinion, I think is guilty of all of this. They were complicit in the robbing of America.
Do you think calls and puts and shorting should be allowed? Should those markets exist?
I do have a sense of common sense solutions, and let me kind of give you them, and then you can tell me what you think. So the first is we need to use modern technology. Let's just start with that, right? To ensure that, one share of stock, right, isn't loaned out multiple times, so that you can't have a scenario where you have more than 100% short.
That's a no-brainer, right?
That's a no-brainer.
So you still support shorting, Chamath?
Yeah, let me just go through the list, and then you can tell me what you think. If high-frequency firms can trade tens of millions of shares per day, there's no reason why we can't reconcile who the beneficial owner of every share is. So maybe that's now maybe we found the first obvious use case for a blockchain, right? Like you can't borrow a share unless you can prove beneficial ownership in a nanosecond, which can only be done on a decentralized ledger. But the point is, number one is we need to rebuild this infrastructure. You can't have 136% of a company be short. That makes no sense. The second, what we've learned is that, again, it's like, are we going to basically have these blowups every 10 years before we actually address the elephant in the room, which is leverage? Like, you need to have leverage limits. So, for example, banks coming out of 2008 have super strict oversight and leverage limits because they're dubbed systematically important. We don't do that for hedge funds, and I think we need to. And I think that we need to have the ability to realize that these guys can cause systemic risk, right? So, just on this example, I don't know if you guys have ever heard about long-term capital management, LTCM. This guy, John Merriweather.
The Asian currency crisis, the whole thing collapsed. There's a good book on it.
Well, so it's funny, but if you guys think this is the second financial calamity, it's not. It's the third, because the first one happened in 1998. So in 1998, there was a firm called...
The whole economic system was going to collapse if the bailout didn't happen.
So listen to what these guys did. Long-term capital management borrowed. They had $4.8 billion of capital that limited partners and investors gave them, okay? These fucking crooks were able to then borrow $125 billion. $125 billion on the $4.8 billion of notional. So they were able to lever themselves up 26 times.
By the way, synthetic margin, right? No actual capital was allocated to these to this transaction set. It was all synthetic. Like no money moved accounts when
no money moved
happened.
Accounts.
So it was literally just writing stuff against debt that couldn't have existed.
Yeah. So they built 60,000 trading positions, and those individual positions represented again $1.4 trillion US dollars. Right. So you took these guys in a room, took 4.8 billion, got knucklehead over here to give them 125, and then got these knuckleheads to sell them positions. And all of a sudden, 4.8 billion equaled 1.4 trillion. And so then US regulators had to step in. They had to orchestrate a bailout from a consortium of banks because they were concerned that if LTCM collapsed, the whole system would collapse because they didn't understand. So